Hi, I'm Billy Keels, the host of the Going Long podcast. Every week, I'm going to be here interviewing the absolute best in the business as it relates to real asset investing, as well as real Main Street investors. We're going to be having conversations where you can listen in, and that's going to help you to continue on your path to education so that you feel much more comfortable as well as confident in investing long distance. So make sure that you go ahead and subscribe to the channel. Make sure that you're liking it as well, because that way you can get every single episode as soon as it comes out. And by the way, don't forget to leave today's episode a 5-star review. Let's go ahead and listen to today's conversation. Welcome to the Going Long podcast, where we're here to once again help to educate you so that you feel confident so that you can invest beyond your backyard. I'm your host, Billy Keels, and today, if you're looking to understand how you can create returns outside of Wall Street, even if that's all you've ever done, then you're definitely going to want to stay engaged to this entire conversation. The reason for that is because today's guest has been able to do just that and even more. So someone who is actually living now in the center of the high-tech world, who spent over 15 years working in Wall Street and the paper asset world, even with high wealth individuals, and has been able to create a really clear plan and took action that allowed him to even walk away from his corporate role. He's also the founder of Black Forest Investment Group, and it's my pleasure to welcome on today's show, Mr. Ed Cernobori. Welcome, Ed, to the show.
Great. Well, thank you so much for having me on.
This is awesome, man. It's going to be a lot of fun. So, hey, Ed, I always like to kind of start off with two questions. And the first one is, I'm sitting here in Barcelona, and I would love for you to help the other Going Long audience understand, where are you in the world today?
Sure. So I live in Palo Alto. So I live in Palo Alto, California. So I pretty much grew up down the street or down in San Mateo, so not too far away. But yeah, I live in Palo Alto. So it's a nice little place to be.
All right. Awesome. Perfect. Hey, listen, other thing, just before we kind of get started, I always like to focus on the things that are positive and happening in our lives. And I know our audience is as well. Can you just share with us, what's the coolest, most positive thing that's happened to you in the last 24 hours?
Funny. I actually started using one of my neighbors who actually had just come back from the East Coast, had kind of finished her little quarantine now that we're in this little COVID thing. And so she came down for dinner last night. And so we basically, got to hang out a little bit while we're still practicing our social distancing, but, it was great to have some human interaction. So it was great. So I had a really nice dinner with the neighbor last night.
Okay. Awesome, man. Yeah. And during this time, it's really nice when you can get to actually physically see people and stuff like that. So thanks for sharing that with us. And look, so Ed, let's jump right into the conversation today, man. There are so many different, I'm sure, points in your life that have helped you to get to this point, right? And a number of decisions that you've made to help you become a better person, a stronger, more influential investor as well. And really love to give the audience an opportunity to get to know you a little bit. So can you talk to us a little bit about some of the things that have helped you to get to this point in your journey?
Sure. So really, I've always, even as a growing up as a kid, I've always been interested in finance. It's just one of those things where my dream job coming out of college was to go into Wall Street. And I think I had seen the movie Wall Street one too many times, where I thought it was going to be something super exciting. And it is. It definitely is. But it's just one of those things where you have a dream that you really want to achieve, and you want to get to that place, and then you get to the job, and then you, while you do it, it sometimes it's not always what it looks like in the movies. But that being said, it's like I did love it, and I loved working with people, helping people, as best you can. And then that's kind of how I stayed in my role, being a financial advisor. So I bounced around to a couple different firms, kind of just upgrading as you kind of go along. And then was really privileged enough to be working with one of the largest financial institutions on the planet for quite a few years, and was doing great. And then that's when I started learning about other avenues, because what I was doing wasn't necessarily working as much as I wanted it to. So that's where I started learning about real estate investing. That's when I started learning just about looking at other asset classes is really that's kind of how the journey started.
Okay. And so, there's so many of us. I appreciate you helping us get started on this conversation. So many of us start out and will start with the paper assets because that's what most of us know. And one of the things that you mentioned, you said that as you were involved in that world, you had a dream about that. You were fortunate enough to actually follow through with the dream and became a part of that world. But you said that it wasn't working out as well as you thought it would. What does that mean? Kind of what were some of the things that were happening to you that led you to feel that it wasn't working as well as you thought it was going to?
Sure. So that's a good question. So it's a combination of a few different things, because really it's like you have to realize that the stock market, it's like you don't get the returns that are as advertised, I would say, because people just expect to get that 10%, 8% return consistently. And that never happens. I mean, it doesn't happen for a myriad of reasons. I mean, primarily because people are always quoting just the stock market when we're looking at those returns. And you're not including like a balanced portfolio. And a balanced portfolio, after all the fees are all said and done, after fees and taxes, don't really get you ahead. And so it becomes very apparent that there's something that's just broken. There's like a fundamental flaw in how Wall Street is designed. I mean, it's just, while people can do great there, and it's a great it can be a good store of wealth, and especially if you work for a company, like because I live in Silicon Valley, and a lot of people here really make or break their fortunes with company stocks, and with stock options rather. So I've seen where people have come in with, 20-year-olds come in with high six-figure checks a lot. And it just happens that they come in, cash out, and then it's funny because one of the first things they do is actually buy a house with that money, but that's another story. So it's, if you're not, so there are two different ways on how to approach it, because if you're actually having that company stock, that's one thing. But if you're kind of like if you're the average person and you're just kind of putting your money into a 401k and kind of a diversified type of portfolio, you don't have access to the money. Your lifestyle is actually diminished by you putting all that money away. And while you're thinking that you're growing all this wealth, it's like you're not, and you're stuck on a treadmill. And it's like it becomes very apparent, even though I was on the other end of it, just watching how you can watch all these families struggle, even though they're doing, quote unquote, the right thing. And so even though you're doing the right thing, and you think you're doing the right thing because that's what you've been told to do, or that's just kind of what's expected. I mean, there's no real rule book because nobody teaches you about money in college or in school, for that, any kind of school, really. You kind of just do what everybody else does. And the system does not work like it's supposed to. I mean, you're not going to get the returns, number one, that you kind of expect. You're definitely taking on significantly more risk than what you might imagine. And that's really the part that's a killer for me personally, because I've seen and been a part of, obviously, because I'm doing a lot of the recommendations for these balanced portfolios. So I'm directly participating in I wouldn't say demise might be a strong word, but I mean, it's something where you have like somebody that's saving for retirement, and then all of a sudden, it's happened to my parents. It's happened to multiple families where they have to delay retirement because of no fault through no fault of their own, but they have really just, because the stock market goes down, and it's like, it is very volatile. And so it's always between the volatility, between the fees that you get charged, and between the actual returns. Those are the three of the four underlying reasons. And those are the three most obvious reasons. In my opinion, the biggest reason that none of this works, and the number one reason that people need to be cognizant of in any type of financial planning is inflation. And that's like, inflation will either make you or break you. And that's the biggest thing that most people, and especially with a financial advisor, they don't take that into account. So it's not on like a little chart where it says, it's growing at 2% a year. It's like, it does not grow at 2% a year or whatever. It's just, sometimes it goes by a lot, sometimes by a little bit, but it's significantly more than is reported. So that's the one thing that you have to watch out for. And that's the one thing that's the biggest thing you have to watch out for, rather. And it's one of the things that's almost never accounted for in financial planning.
And so I think this is a great opportunity for you to help to educate us, right? Because one of the things that does happen is we forget and we don't necessarily, or we just follow the person in front of us or follow what we were shown. We may not necessarily do the homework up front. So this is the chance to make that impact. So there are two things that you just mentioned that I think will be really important to share with our audience. Number one, you talked about fees. And second, you talked about there is more risk than people are thinking about. If I want to just pull out just those two things, help us understand when you say that there are things that we're not thinking about, such as fees, what do you mean by that? And then afterwards, if you could talk to us about that risk element.
Sure. So for fees to start out with, fees have come down significantly more than what they were, 10 years ago or whatever, but they're still a significant part. And kind of let me explain how. I mean, most people, when they're working with a financial advisor, have a lot of them are in some kind of like a wrap program, meaning if let's say you have $100,000 and you're basically getting charged this 1% fee by the financial advisor. So you think that that's just 1% of the whole 100,000. 1% doesn't sound like very much. What you're not taking into account are two different things. So number one, that's just a financial advisor's fee. That's not the underlying asset fee, which is usually either a combination of mutual funds and ETFs. And so you can easily add, and those are underreported as well in the prospectus because they're usually a little bit higher. So it ends up being about 2%. So call it like, even if you think you're being charged 1%, it's usually 2%. Okay. So that 2% is so you're basically being charged that $2,000. So let's say you have this great year and you're making, in a balanced portfolio, you get 10%. So you have to realize that 2% you're getting charged is actually 20% of the growth of that $10,000, right? So, and that's on an up year. It also, that same fee gets on down years as well. So it's like you're getting charged 20% of the growth regardless. And that's what the conservative, I mean, that's on a conservative level. I mean, I've seen other firms that charge a lot more. And that doesn't include taxes as well, because every single year you have taxes. If it's a taxable account, then you're going to be taxed. And then that further eats into your performance. So that's like I'll figure at least another 1% on top of that. So that all of a sudden that's 30%. So you're basically looking at a 30% fee every single year, whether you're going up or down on your average performance. And that's if you're getting 10%, which most of the time it's not 10%. Most of the time it's more like 6 or something like that. So in reality, between the fees and taxes, that's literally half of your gains, but you don't realize it because that's just kind of how it goes. And especially you don't realize it if it's in like a 401k or something like that, because you're contributing every single month. So yes, you see the balance going up every month, but it's not growing the way you might think it is.
Okay, so then there are fees beyond that 1% that we talked about. Sounds like that's in that small print typically that most of us may gloss over. So yeah. I think it probably, based on what you're saying, Ed, would really make heed everyone to read that small fine print and really understand what is the true fee that you talked about. So I think that's very helpful. And then you talked about some of the risk element as well. So it's a bit more risky than we may think. So help us unpack that a little bit.
Okay. So, I mean, some of the biggest things with risk are people's portfolios have changed over time, especially now with the interest rate environment that we're in. Before it used to be it used to be almost based, like if you're looking at a typical type of retirement account, they used to almost be based, it used to be based on your age. So if you were, for example, if you were 25 years old, you had 25% of the portfolio was in bonds and 75% was in stocks. Let's say by the time you get 40, then we have 40% in bonds and you have 60% in stocks. And conversely, by the time you get to be 65 or so, then you have 65% in fixed income or bonds, and now you have 35% in stocks, right? Because because essentially bonds are less volatile, or supposed to be less. They're less volatile than stocks are, right? So as time goes on, because what you don't want to do is get caught like we always, or like what we've kind of seen, is that you're overbalanced in stocks, and if your stock market can go down by 30% at any given time, then you don't want to be too risk averse. But what's happened now is all these portfolio managers are trying to get gains, because it's really difficult to have any fixed income if you're getting 0% interest or negative interest, which in Europe happens, which is, it's insane to me, but still, regardless. And there's counterparty risk, which is a whole nother thing. But but the point is, the portfolios are significantly more risky right now than they were before. So in previous generations, even a few years ago, they weren't nearly as risky as they are now, because portfolio managers have to bet on the stock market to outperform, because they know they're getting zero in the bond market. So even though they're trying to be safe, they're trying to navigate this unforeseen world that just doesn't exist anymore. So and so basically, portfolios now in general are significantly more invested in the stock market.
Okay. And I think that then has a lot to do with the way that the portfolios are managed, and some of the different theories around the portfolio management, right? So we're maybe doing that on old rules, and today's reality is very different, which inherently brings about a risk for everyone. So really, I guess you want to make sure that what I hear you saying is that you want us to make sure that we understand that today's rules should be played based on today's context.
Yes, I would absolutely say that. So you have to keep that into account. And there are also accounting practices that are allowed now today that were not allowed before. So you can look at, like, one example would be, not to get too much into the weeds or whatever, but I mean, if you look at a company like Salesforce, they don't actually print out their data. They're basically printing out a pro forma, and people are investing on a pro forma, a pro forma is nothing but a guess of what it's going to be. And so how is that? It's like, it shouldn't be legal, but stuff like that works. Like it just flies now when it never has before. So so it's less clear now how companies are investing and what they're doing than what it was 20 years ago. And it absolutely should not be that way, but it's exactly what it is. So not only do you have less guidance and less clarity of what a company is actually projected to earn, but it's everybody's doing it. So it's just a whole different way of accounting that had never really existed before.
So there are a bunch of things that are happening then with the fees, and we mentioned asking the questions and also going into your prospectus to really understand how that affects you in terms of the overall return. So now we're talking about risk. So what can you do to actually make sure that you understand the true risk or the systemic risk that are there?
So the first thing I would do is become educated on basic. It's like you almost have to, or kind of how I did it, after I kind of figured out how all these practices were going on. You really do have to dig into the numbers, because this stuff it's not apparent, and not a lot of people just do it, and even analysts don't do it, because in my opinion, they're basically paid by somebody, a big corporation, or who's managing the money, to basically either give them like a thumbs up or thumbs down for an investment choice. And it's not unbiased. Let's put it that way. And so you have to be really careful on what kind of analysts you follow. So that's the start, but you also have to become really educated just on what money is in general and what it does for you. And so it's like, really have to take a not just one step back, but a whole bunch of steps back on what money is to start with. And kind of that's really where the biggest changes started happening for me, because it wasn't just like, should I buy this stock or this stock? It's what is a stock, and why should I buy it? And what is a bond, and what are all the different things that I can invest in, and what do they do for me? Because and you don't know to look at those questions, because those aren't at the forefront of your mind, because that's kind of just how we're trained as, or that's how I was trained, kind of as not as part of my job. That's how you're trained, and you just don't ask those bigger questions, because those go into completely different scenarios that are outside of your job in general.
So I think, well, you've given us a number of things to really think about, right? And some of the questions that you want to be asking yourself, and you talked about the education. We'll get into some of the things like the concrete steps that people can take to be able to do that. But with what you've painted for us so far, this is, I guess, one of the main reasons that you decided to say, hey, listen, this was your dream, but you made a very important step. You walked away from that dream to go out and start your own new dream in a world around assets that were probably not on your radar before you started in that world. So maybe you could talk to us a little bit about being able to walk away from your day job, leaving that dream in the past and moving into something else. Help us understand some of those drivers there.
Sure. So really it came from just listen, because I had always been working, and just it's like kind of the thing where you're working, and then you had a good job, so that was fine. And it's not like I was going broke or anything, but I really always wanted to have some other asset class, and I always wanted to invest in real estate. But living in the Bay Area was really difficult, because there was nothing around here to buy that was affordably priced. And it's like, and what did I know about investing across the country or something like that? So I finally had the chance to buy a property that was in Texas for, I think my first property I ever bought was $77,000, and the rent that was coming in was $1,000. So I was like, well, that's got to be a good deal. So that's kind of just where I started the whole thing. That's actually the first house I have ever had, and it's still one of the only houses I've never actually visited in person. But it started there, and then the light really started coming on when I started seeing how much appreciation there was, how little real maintenance there was on the property, and how much better everything was than working in the stock market. Because I think it's like being on a treadmill. I mean, kind of circle back a little bit, but like I'm like, you're just going and you're just working on a treadmill kind of, and that's fine. And you're basically, I was making, decent money, and that's fine. But it didn't, I didn't have an out. Like I didn't know how, like what else there was until you actually start doing something. And so I basically kind of bought the property. And then after that, I got hooked a little bit, because realizing how much better the returns were. And actually, it's like I was actually getting the returns that was promised to people in the stock market, only it was with much less risk, much more consistency. And it's something that's tangible. So it's like, that no matter what, it's still going to be there paying you something, right? So I'm kind of lost myself a little bit, but that's kind of where it started. And then I basically was doing significantly better with I started acquiring these little properties all over the place. They're, I guess, little in price. Like $50,000, $60,000 properties. And then really, it's like I didn't realize how much better I was doing with that portfolio, even in like a banner year, like in 2000, I think it was 2016, the stock market was up like 24% or something like that, and like my little portfolios were doing significantly better than that. And it's like, and I couldn't believe how easy it was and how brainless it was. And it was, well, brainless might not be the right word, but it was so much easier and so much better and so much more predictable. And it actually worked without all the risk and the headaches that comes with just being on this job. And I guess the biggest difference that I saw was that you get immediate benefit, that you get a monthly check. So you're literally starting to replace the income that you've always been working so hard on. So that's kind of when all the lights started turning on. And then I started really kind of listening to a lot of the different podcasts. And then that's when I started becoming educated in real estate. And that's when I really started going.
So Ed, a couple of things, right? You've helped us to understand you were in a role where you were, it was your dream job, and you were in your dream industry. You were doing well, and you decided to look for something else, right? And you did something that was very I would say, non-traditional in that you made your very first rental property. You bought it thousands of miles away because you were living in California and your first property was in Texas. And so you must have come up with a process for that. And so if you could go into what kind of that mental process was for you, I think that would be really helpful. And then at the end, if you could just kind of tell us also too, kind of where are you investing today as you are in Palo Alto, California?
Sure. So the biggest problem, like, so it really comes down to, it's like I've always wanted to have some kind of extra income coming in, and Wall Street does not do that. I mean, there's nothing that's going to pay me any kind of income, anything close to what I can receive by investing in real estate. I just didn't know how to go about doing it, but now it's easy. Now it's easier than ever to do something like that. And again, some of the benefits of real estate are, number one, it's the income that you get every single month, and it's like and it really kind of helps you get off that treadmill. And number two is that the portfolio does appreciate with inflation. So and also the rents go up with inflation too. So it's like you're kind of marking off all those boxes. The process was like I just needed to find a way to kind of figure out how to stop working as much as I did and not take all the worries that I had. Because every single month it's like you have to hit your quotas and all that other stuff, and it's like that's fine, but and you go ahead and you do it. But the other thing is that then as soon as you kind of realize how it works, then everything starts unraveling as far as like how to invest, and then you start digging into the economy in different ways. Like I think it was shortly after I bought that first property that I found that book, that I discovered that book. It's called The Creature from Jekyll Island from G. Edward Griffin, and that book literally changed my mind. I mean, that changed my entire life. So basically, after I read that, that's when my whole transition changed, because when I first bought that investment property, I wasn't looking to change careers or anything. I wasn't sure what I was going to do, honestly. But I mean, I knew that Wall Street wasn't doing what it was supposed to do, so I was trying to find extra income to kind of support myself while I figured out whatever I was going to do. And then I read that book, and then that's literally when like my entire life got flipped upside down. And then you realize how it's a big insight on how the actual systems work.
Yeah, that book tends to have a big impact on anyone and everyone that reads it.
Right. And so, I mean, I can't recommend it enough. And I did the audiobook because it's a big, huge, thick book, and but audiobook, it's great. But I mean, pretty much after that, that's when I started looking into the economy. That's when I started digging into like alternate views of the economy rather than just the people who are kind of front and center. And so it's a completely different point of view. And as soon as you figure that out, then I realized I had to leave Wall Street because I couldn't do my job and have a conscience at the same time, because I just couldn't do it. So I had to basically change everything that I did. And while I couldn't figure it out, I knew that real estate was paying me income. So while I was figuring out, I was kind of acquiring properties. And then after I had a few, then I actually went to the real estate guy's Secrets of Successful Syndication seminar. And then that's when I said, oh, like this is literally like being a financial advisor, only I can do it with a conscience. And so now that's where I took off, and that's when I started my own company. But it wasn't.
So that's great. So we get an understanding of how this journey that you've been on. It's taken you to a point where you really had a moment to say, hey, listen, this is something that I now understand that I can do. You found, when I say that, meaning that you can invest through real estate and be able to achieve some of the goals that you set out for yourself. You did that in Texas, but just give us a quick idea as also which other geographies or locations are you currently investing in?
So I invest primarily in the Southeast. I mean, one thing about real estate, it's like one of the beauties of it is that you can see it coming from miles away because it's really just based on migration patterns. So it's not like the stock market where you don't know what sector is going to be hot or whatever. It's it's very slow, very steady, just these different migration patterns. So I started in Texas. I invest primarily in Texas, Atlanta, well, I mean, both Houston, Dallas, Atlanta, Georgia, Jacksonville, Florida, Tennessee, and Memphis in Tennessee. And so basically out throughout the Southeast, I'm like wherever the job growth is, that's kind of where you want to get to. And being nimble, because I primarily stay with single family homes. I love those portfolios. And now I actually build portfolios like that. But that's just kind of what I do. And it's like it's easy to see the migration patterns, and that's where I invest. So I invest in cities like Atlanta and Jacksonville primarily.
Okay, perfect. So, and I think the big idea here is that you are able to do that from the place where you actually enjoy living, and you can make sure that you're investing for yourself and your investors where it makes sense. So this has been really helpful. And actually, you know what, Ed, I want to kind of pivot to move to our final 3 questions for today, but I only want to go there if you're ready for us to go there.
Yep, sure thing.
All right, perfect. So listen, so we're going to start out here with our final 3 questions, our going long final 3 questions of the day. And Ed, the first question, no, I live in Europe. I love living in Europe, and I love investing in U.S. real estate. And so I always want to know from all of our guests, what is your favorite European city, either that you visited or is still on your bucket list?
So I have not been to Europe yet, which is, it blows me away because I still have like family there. But I've always wanted to go to Rome. Like that's one of the first places, is just because you have to go. I mean, there are so many things to see over there.
It's wonderful. It's absolutely wonderful.
Yeah, so that's the first place I would go, and I could think of like 10 other places, but that's
the one. That's the one. Awesome.
That's my first one. That's the first one I'm going to go to soon.
Okay, perfect. So then, second question is: throughout all of our lives, and you are now an accomplished real estate entrepreneur, investor, and I'm sure you've made a number of mistakes along the way, and you paid full price for those mistakes. And so, we just really want to understand what piece of advice can you now pass on to someone else so that they don't pay full price for the mistakes, they can actually benefit? So what were the learnings that you've made from those mistakes?
Yeah, I would say the first thing is to remain open-minded and to get educated, and the sooner the better. And you do that by listening to podcasts, I mean, just like your podcast, and kind of just get immersed into opening up your mind, because opening up your reality, I guess, because while we're on, a lot of the times we're basically just kind of stuck on a track, and we're moving on this track. And while everything is great, like you really don't realize where you're going unless you kind of like take a step back and like kind of focus on what your main goals are, or kind of like take some time to get, figure out what your goals and get educated. So those are the 2 main things. And I wish I would have done those earlier, but we do them whenever we do them. So.
Well, we appreciate you sharing that with everybody else so they can take advantage of that advice and be able to do exactly that. So stay open-minded, which is fantastic. So, and then the last question, and we're going to wrap things up, is I know you like to read, and I know all of our guests love reading. I guess what book would you share with us that you believe will make a strong impact on others?
Yeah, I mean, I think the one I had mentioned, The Creature from Jekyll Island, is, I mean, I can't tell you how much it's changed. Like me personally, it changed my life completely. I mean, I don't know anybody that it doesn't have like an impact who's read that book, that it doesn't have a significant impact on how they view on how they view just money and just life in general. So that's the biggest one that that one's made the biggest impact on my life for sure.
Fantastic. So The Creature from Jekyll Island, once again, G. Edward Griffin, it is definitely a book that has made a big impact on me as well. So thanks for sharing the final 3 questions here in the Going Long podcast. Questions. So listen, Ed, we've learned a lot, really help and appreciate you sharing your dream that you had as a kid, being able to work in Wall Street, having a chance to work within the paper assets world. You were able to live that dream. Once you got there, you started seeing some things that you weren't really prepared for. You've started to share some of that with us today, really helping us to understand some of the different things like risk that are inherent within the paper assets world, giving some tips on things to really look for as we think about things like transaction fees. There's probably a little bit more in there. Make sure we're reading the small print or asking the questions. As you mentioned too, you also became very comfortable with making your very first real estate investment and doing that long distance. It's motivated you. You've had a lot of success, enough that you were able to walk away from that first dream, move into a new dream, and be able to continue to invest long distance for yourself, for your investors. And we really appreciate that. And because of that, I am sure that there are so many people that are listening and watching right now. They're thinking, how in the world can I get in touch with Ed as quickly as possible so that I can talk to him, so that I can learn from him, and so I can just connect with him? So can you help us all out? Ed, really want to know, what is the best way to be able to connect with you?
Yeah, absolutely. So the best way is to go to my website, which is blacktreegroup.com. And then and I'll also have a few different reports that are available for people, whether it be, stocks versus real estate, or like an annuity versus, single family home. So there are a few things that are on there that I think people would be interested in. So yeah, I'm happy to share, and they're happy to show some people what get some people on like the newsletter, and happy to just give content, because I'm really want to help educate people on what some different things are that are available.
All right, perfect. So everybody, you've heard that. Go ahead, reach out to Ed. We're going to make sure that we include it in the show notes, as well as on the different platforms, so that people can reach out to you right away. And as this, once again, this has been a fantastic conversation. For those of you that are watching, that you're listening, and you want to make sure that you've received value from this content, go out there and make sure that you're sharing this with at least 2 other friends. So really appreciate that. Help our community to continue to grow. Once again, this is Billy Keels with the Going Long podcast. I'm really looking forward to welcoming you back to the next episode. Thanks so much, and everybody make it a great day. Wow, don't you love hearing from top-notch experts in the field? When I was getting started, I really wish that I would have had access to such experts. And even more, I wish they would have given me like a really simple list of things to follow, so that I could have gotten to my goals much faster and been much happier even sooner. So that's why I've created for you the 7 things that you should avoid in order to be successful in long distance investing. And you can pick that up really easily by going to billykeels.com/7 things to avoid. And also, if you liked today's episode, don't forget to leave a 5-star review. I'm looking forward to seeing you on our very next episode, so go out and make it a great day.